Welcome back, students, to Accounting 2401, Principles of Financial Accounting. Once again, this is Dr. Mercado speaking. We are continuing covering Chapter 12, which deals with corporations. We're learning about the organization, stock transactions, and dividends. In this particular lecture, we are going to be covering Problem 12-2A. Okay, so by now, all of you should have already read the chapter. If you have not done so, please read before you attempt any of your assignments, because if not, you're going to be completely lost. Okay. Now, problem 12-2A deals with stock transactions for corporate expansion. Okay, it states, on December the 1st of the current year, the following accounts and their balances appear in the ledger of Lat Corp, a coffee processor. Okay, we have preferred 2% stock, $50 par, 250 shares authorized, 80,000 shares issued. We've got $4 million in our books. We've got paid-in capital in excess of par for preferred stock, $560,000. We've got common stock at $35 par, 1,000,000 shares authorized, and we've got 400,000 shares issued. We have it in our books for $14 million. We've got paid-in capital in excess of par for common stock at $1,000,002, and we've got retained earnings of $180 million. Okay. At the annual stockholders meeting on March the 31st, the board of directors presented a plan for modernizing and expanding plant operations at a cost of approximately $11 million. The plan provided that a building valued at $3,375,000 and the land on which it is located, valued at $1.5 million, be acquired in accordance with preliminary negotiations by the issuance of 125,000 shares of common stock. B, that 40,000 shares of unissued preferred stock be issued through an underwriter. And C, that the companies borrow $4 million. The plan was approved by the stockholders and accomplished by the following transactions, which we're going to be recording. Okay. Let me go ahead and insert here another column for the date, because these specific transactions do have a date. Okay. So let's go ahead and enter that. Okay, so we have a journal set up here with the date, the account, the debit, and the credit. And we are to journalize these transactions that occurred May the 11th, May the 20th, and May the 31st. So let's go ahead and begin with May 11th. Okay, let me go ahead and just format all of this. Arial 16. Okay, so we are doing May the 11th. Okay, so what happened on May the 11th? Okay, it says that we issued 125,000 shares of common stock in exchange for land and building according to the plan. So what did Lat Corporation receive? Well, with this particular transaction, they have acquired a piece of building and a land. Okay, so what did we receive? We received the building, and according to the information provided, the building was valued at $3,375,000. So we're going to put that in our books. The building cost us $3,375,000. We've got land. The land was valued at $1,500,000. Okay. Now, it says here that we issued that for 125,000 shares. 125,000 shares. And of common stock. If we look at our common stock, each share of common stock is $35. Okay, so we issued common stock of $4,375,000. Okay, so that is how much common stock we issued. Okay, so we've got 125,000 shares at $35 a share. Okay, and we, based on our calculations, that gives me $4,375,000. Okay. Now, if we add, okay, the $3,375,000 and the $1.5 million for the land, that gives me $4,875,000. Okay, so if we add the land and the building, they're valued at $4,875,000, and we're only giving them 125,000 shares at $35 a share, which, if we subtract that, that means I'm short $500,000. Okay, so If the company was okay with receiving $4,375,000 of stock in return for something that's valued higher, something that's valued at $4,875,000, then what happened here was that we had a premium. Okay, if we issue out stock at a higher price than par value, we are issuing at a premium. Okay, so in this case, okay, we're going to go ahead and we're going to say, okay, the land and the building, if we add those together, are valued at $4,875,000. I'm going to divide that by the number of shares that I received in return for the land and the building. Okay, that gives me $39 per share. Okay, so we were okay in receiving 125,000 shares and basically at a value higher than the par value. Okay, so it was at $39 per share. So that additional monies is going to be put into an account called paid in capital in excess of par. Okay, so this is the amount that was provided in excess of the par value. Okay, my par value is 35. We are issuing, or in this particular case, the value of these stock is being obtained at $39. Okay, so we're going to go ahead and we're going to record our common stock at what it is at par value of $4,375,000, and then we're going to say, you know what? In this particular case, we had paid in capital in excess of par. Okay, and we have 125,000 shares. Okay, times, and we have $39 that we calculated minus the $35 actual par value. Okay. Okay. And then that's going to give me my 500,000. Okay. Remember, from our last conversation we had over here, okay, if stock is issued or sold for a price that is more than its par, the stock has been sold at a premium. So if the stock has a par value of 50 and is sold for 60, that stock is sold for a premium of 10. In this example, my common stock is at 35. We sold our common stock at $39. Okay, because now what we do, we get our $39 and we multiply it by the 125,000 shares. That gives me $4,875,000, which is the value of the land and the building. Okay, so our actual value, even though par is 35, we went ahead and we paid a premium for it at $39. Okay, and we obtained the $39 by getting the total cost of both the land and the building, dividing by the number of shares outstanding, okay, that we're issuing, and that gives us $39 a share. Okay, and if we look here, the debits need to equal the credits. Let's make sure that they do. Okay, we've got $4,875,000 on the debit side and $4,875,000 on the credit side. Okay, so that is a transaction dated May the 11th. Okay, on May the 20th, we issued 40,000 shares of preferred stock, receiving $52 per share in cash. So we received $52 when our par value is $50. So once again, we received more than the par value. Okay, so this is at a premium. Okay, this is happening on May the 20th, I'm sorry, May the 20th. So in this case, we received cash. Okay, so we received cash, and we're gonna go ahead and 40,000 shares were issued at $52 a share. Okay, so if we do that, we have 40,000 times 52. That gives me $2,080,000. That is how much cash we received. Okay, in return for preferred stock. Okay, remember we have to label them different. This is preferred stock. Now our preferred stock, we always have to record it at par. We've got 40,000 shares and the par value of my preferred stock is $50. Okay, so we always have to record our entry to either the preferred or the common stock at par. Okay, so in this case we've got 40,000 shares at $50. That's going to give me $2 million. Okay, and then the difference is the excess or the premium, and that one we're going to have paid in capital in excess of par. Okay, and then we're going to have preferred stock, and then we're going to have the 40,000 shares times the 52 minus the 50. And here I forgot to put paid in capital in excess of par, and we should put here common stock because we need to identify, is that paid in capital for common stock or is that paid in capital for preferred stock? Okay, so we need to make sure that we annotate what kind of paid in capital that premium is. It for my common stock or is it for my preferred stock? Okay, and that amount is going to be the $80,000. Okay. So remember, we issued out 40,000 shares. I'm sorry, 40,000 shares. The par was $50. That's $2 million. But these people paid 40,000 times $52, $2,080,000. So the difference between the par value and what was paid is that paid in capital in excess of par of $80,000. Okay, so that happened on the 20th. On the 31st, we borrowed $4 million from Laurel National, giving a 5% mortgage note. Okay, so what did we receive when we got this mortgage? We received cash of $4 million in return for a mortgage note. Okay, so we're going to have a mortgage note payable of $4 million. Okay, so that third transaction does not deal with issuing any stock. It just basically means we went out there to the bank and we borrowed $4 million. Okay, that's all it means. The first two we did have stock transactions. We issued common stock on the 11th and preferred stock on the 20th. Okay, remember, if they are issued at more, okay, higher than the par value, then those people are paying a premium for those stocks. Okay, and we have to make sure that we account for that separately. Okay. And we remember also when recording our entries, we always have to record the common stock always at par, the preferred stock always in par, and then we have an excess that is accounted for in a separate account, either paid in capital in excess of par for common stock or paid in capital in excess of par for preferred stock. Okay, and those paid in capital in excess of par basically keep track of how much was paid in excess of the par value. Okay, yes, my stock is $50 per stock for preferred and $35 for common stock, but there's people that are willing to pay more for it, and that additional monies that is received for those issuance of stock is accounted for in those separate accounts to track those premiums being paid. Okay, so that is basically it for this particular problem. We analyzed 3 different transactions and we recorded them. Okay, if you have any questions or concerns, please make sure that you reach out. But before you do, please make sure that you have read, okay, A lot of information is included in the chapter. Make sure that you read, that you identify the section on your book that speaks about the different topic that you're dealing with. And then if you have questions or concerns, please give it a try. Send me your work. That way I can review your step-by-step calculations and I can be able to provide guidance. Okay, so that is it. Until next time, have a wonderful rest of your day. Bye-bye.